So I've been staring at this diagram for the past week, and honestly, the more I understand it, the more my brain hurts. This is Bloomberg's visualization of how Nvidia and OpenAI fuel what they're calling the AI money machine. And look, once you see it, once you really see what's happening here, you can't unsee it because this might be the most expensive game of financial hot potato in human history, and somehow the stock market keeps rewarding it. So I'm going to try and walk you through this thing arrow by arrow, and it starts with these three circles. We have Nvidia at $4.5 trillion, the most valuable company on earth. They design the graphical processing units that run AI. On the other side, you have OpenAI, $500 billion evaluation, never made a profit. They are the ones actually selling AI services to real human beings. And then you've got these middlemen, Oracle, CoreWeave, Nebius. They build data centers. They buy chips from Nvidia, and then they rent out compute power to AI companies. So it sounds simple enough, right? Nvidia sells chips, data centers buy chips, AI companies then rent the compute. It's basic supply chain stuff. Except that's not what's happening here. It's not even close. So let's talk about OpenAI for a second. $500 billion valuation. That will make them bigger than Netflix, bigger than ExxonMobil. Now, here's their 2025 first half numbers. Revenue is $4.3 billion. Losses, $7 billion. They're basically spending $2.60 for every single dollar that they make. And here's the thing, it's getting worse, not better. In 2024, they were only spending $2.34 per dollar of revenue. Wait, what? How does a company lose more money per dollar as they scale up? Isn't that like the opposite of how businesses are supposed to work? Well, here's the thing. Every time they release a better model, GPT-5, whatever comes next, it costs more to run per query, not less. So more compute, more thinking steps, more money burning. So their losses are literally built into their product roadmap. But sure, $500 billion valuation makes total sense. Now, here's where it gets interesting. Nvidia is absolutely printing money right now. Their profit margins are insane because the demand for their chips is supposedly through the roof. Their H100 and GB300 chips are selling at 4 to 5 times the price they were a few years ago. So if demand is so high, why is Nvidia doing all of this? Look at these green arrows. Nvidia is investing in Maestro, Figure AI, XAI, CoreWeave, and yes, OpenAI. And what do all of these companies do with that investment? They buy Nvidia chips. So if your product is so in demand that people are literally lining up to pay premium prices, why do you need to invest in your customers so that they can afford to buy from you? It's like, imagine if Apple started giving venture capital to teenagers so that they could buy iPhones. You wouldn't do that unless you needed to create the demand yourself. But here is where it starts to get really weird. You know, the deal that made everyone go, wait, what? It's September 2025, and Nvidia announces that they will invest up to $100 billion in OpenAI. Now, fun fact, Nvidia has only $57 billion in cash and short-term investments. So how are they investing $100 billion, you might ask? Well, that's a great question. Here's how it actually works. 1, Nvidia agrees to invest $100 billion in OpenAI. 2, but this investment is actually tied to OpenAI buying Nvidia chips. And 3, essentially, Nvidia is giving OpenAI about a 20% or 25% discount on chips in exchange for equity in OpenAI. So here's what happens. Nvidia invests $1 billion. OpenAI immediately spends that $1 billion on Nvidia chips. Then that $1 billion goes right back to Nvidia, rinse and repeat. It's not really a $100 billion investment. It's a $100 billion purchase agreement disguised as an investment. And here's the kicker. When this deal was announced, both companies' stock prices went up. The market saw this circular arrangement and said, yes, this is fine. This is normal business behavior. Cool. Cool, cool, cool. Okay, so that's absurd. But you might think to yourself, well, at least it's contained to OpenAI, right? It's just this one weird deal. You'd be wrong, because right after the Nvidia deal, OpenAI signs a $300 billion service contract with Oracle. So let me put that into perspective. OpenAI makes $4.3 billion per year in revenue. They just signed a contract worth 70 years of their current revenue. For a company losing money on every transaction. Oh, and by the way, what is Oracle doing with all this money? Well, they're building massive data centers. And to build those data centers, they need, well, you guessed it, Nvidia chips. Tens of billions of dollars worth. So the money flows, Nvidia invests in OpenAI, OpenAI pays Oracle for business, for data centers, Oracle pays Nvidia for chips. Follow the pink arrows on this diagram, they all lead back to Nvidia. And when Oracle announced this deal, their stock surged, even though their cloud business has 14% profit margins. So this means that they are making 14 cents for every dollar that they spend on a $300 billion contract. Yeah, the math is not great. And look, here's the really uncomfortable part. The people running these companies, they know that this doesn't add up, but we'll talk about that in a minute. But first, it gets worse, because this pattern of circular flowing money is just not these two deals. Look at this arrow here, CoreWeave. They're a data center that went public this year. Nvidia owns 7% of them and has agreed to buy $6.3 billion worth of cloud services from CoreWeave. But here's the deal. Nvidia guarantees CoreWeave's business. If CoreWeave can't find enough customers to use their compute capacity, then Nvidia has promised to just buy all the excess capacity themselves. Yeah, let me say that again. Nvidia is investing in CoreWeave, selling chips to CoreWeave, promising to buy services from CoreWeave, guaranteeing CoreWeave's revenue if they can't find customers. Well, why would you guarantee your customers' business unless you're worried there might not actually be, enough real demand? And as if this web isn't crazy enough, OpenAI gave CoreWeave $350 million before the IPO, plus $22.4 billion in cloud deals with them. Now we have Nvidia to CoreWeave, to OpenAI, to Nvidia, to OpenAI, to CoreWeave. It's a triangle of definitely not circular financing, we promise. Now, I almost forgot about Microsoft. They seem to be the only major player here buying chips the normal way, just writing checks to Nvidia directly. But then I dug deeper. You see this little connection here, Nebius? Nebius is a cloud provider that split off from Russia's Yandex. Microsoft just signed a $19.4 billion deal with them. And Nebius, well, they're getting investment from, yep, you guessed it again, Nvidia. So Microsoft is securing 100,000 Nvidia GB300 chips through a company that Nvidia has invested in. Even Microsoft is getting discounted chips through this web of investments. Literally everyone in this diagram is either taking money from Nvidia, giving money to Nvidia, or doing both at the same time. Okay, let's pause here. If you're tracking with me, here's what we found so far. Every major AI deal involves Nvidia investing in someone who immediately spends that money on Nvidia chips. It's not a supply chain, it's a carousel, and every horse leads back to Nvidia. And now you know why. Now, here's why that should make you uneasy. You see, the actual product isn't the chips. The product is AI services that you, me, organizations use. And right now, AI companies are making roughly 1/10 of what they are spending just on hardware. That's not even counting staff, power, water, buildings. Bain and Company predicts that by 2030, AI companies will need $2 trillion in annual revenue to fund their computing needs. They're currently on track to fall short by about $800 billion. There was an MIT study that found that 95% of companies using AI saw zero return on investment. Not disappointing return, zero. Meanwhile, Harvard and Stanford researchers found that AI is actually creating what they call work slop. AI generated work that looks good but lacks substance, and it costs large organizations millions in lost productivity. So we have, well, massive demand for Nvidia chips, artificial, but real money actually changing hands. Then you have unclear demand for actual AI products that justify these costs. Nvidia stock is worth more than the entire pharmaceutical industry combined. Their profit to earning ratio is sky high because investors believe that chip demand will keep growing, but they are literally funding their own customers to buy their own products. That's not organic demand, that's manufactured demand. And remember when I said earlier that the people buying this know it doesn't add up? Well, this is textbook bubble behavior. And I'm not the only one saying this. Sam Altman, the OpenAI CEO himself, admitted, are we in a phase where investors are overexcited about AI? In my opinion, yes. Mark Zuckerberg, the Facebook CEO, said an AI bubble is, well, quite possible. But here's the thing about bubbles. Smart people know that they're in one. They just think they will get out before it pops. Look at the dot-com bubble. Telecom companies spent billions building fiber optic networks for demand that never, materialized. And when it crashed in 2001, the Nasdaq lost 80% of its value. Even DeepSeek's release in January, the Chinese AI model that was built for a fraction of US costs, triggered a $1 trillion sell-off. Nvidia dropped 17% in one day. And what happened? Well, Silicon Valley just doubled down on spending. Nvidia's stock price went straight back up to fresh records. Look, I'm not saying AI is useless, right? It's clearly doing something. ChatGPT has 700 million weekly users or something like that. But there's a massive gap between useful tool and it justifies a 4.5 trillion in Nvidia market cap plus trillions more in infrastructure spending. The people building this technology are extremely smart. They know that these numbers don't add up. But they also know that, one, no one wants to be the company that missed AI. And two, as long as the next funding round is at a higher valuation, everyone pretends it's working. Three, stock prices keep going up, so the markets must know something, right? Wrong. The market can stay irrational longer than you can stay solvent. That's not just a saying, it's what happens in every bubble. And when this one pops, as it probably will, it won't just be tech companies. It's tied into, debt markets with companies borrowing billions for AI. It's tied into real estate with all the land rushes for data centers. Every major tech stock is in your retirement portfolio. The dot-com crash wiped out 5 trillion in market value. This one could be bigger. And this picture is not one of innovation. It's a picture of companies using increasingly complex financial engineering to make it look like there's demand for products that aren't actually profitable yet. Maybe they will figure it out. Maybe AI really will transform everything and justify these valuations. But right now, it looks like everyone's playing a very expensive game of musical chairs. And Nvidia is the one controlling the music. If you found this breakdown helpful, please hit the like button and subscribe if you want more content like this. And maybe, diversify your portfolio or something. I'm just going to go stare at this diagram some more and contemplate the late stage capitalism of it all. Bye.